Hello, my name's Joe Cordell. Welcome to another episode of Cache Counsel. What I want to do today is to talk about the concept of lifetime gifting. Over this series, I've been discussing ways in which you do estate planning and some of the fundamental concepts, trying to integrate that into the whole subject of executive asset management or asset protection strategies. And I think it's important to kind of get a sense for what the general concepts are that drive sort of lifetime planning. And I'm distinguishing lifetime planning from the sort of provisions you might make in a will. I mean, some people during their lifetime don't actually make any transfers of assets, and they don't do any of those overt acts, but rather simply go to an attorney and prepare a document or a will, and in their judgment that's sufficient and that's that. But those who are wanting to be a little more proactive, a little more innovative and creative, ambitious I should say, in terms of minimizing their estate taxes, achieving asset management goals. In other words, to have mechanisms in place where they better manage the ultimate destination of assets that they've worked hard to protect over the years. Then there are better ways to do it. There are ways that you can have a much more effective plan. You can substantially reduce assets, and as a result, substantially reduce taxes. There are ways in which actually you can have some element of control over these assets, and at the same time have beneficial tax advantages. So there are lots of ideas that are ignored by many people just because they don't want to deal with it. It's a hassle, and to some extent, that's a sort of overarching theme in the whole subject of estate planning is, why now? Why can't I postpone this? Why can't I do this at some point down the road? And of course the answer is, of course you can, and sadly many people do, but it's very wasteful of assets and it often interferes with their goals. So let me talk about some of these general concepts when you think about actions that you might take while you're living. Now really we could probably divide those into two broad categories, and maybe there are more, but these tend to be the focus in estate planning. And that's either that you're going to make a gift of those assets, or you're going to sell those assets. By sell, I mean exchange something for value. That means that you're reducing, in one sense, your assets or your estate, but in another you're acquiring something in exchange. So that's the fundamental difference between the idea of gifting and sale. Nothing complicated there. Now there is a third category that I won't spend much time here with, but I'll mention it to you, and that's simply to deplete your estate, to use up the assets. And whenever you see these Winnebagos, as I've seen on the road, the bumper sticker, I'm living on my children's inheritance, well, that's that strategy. It says, just use up the assets, enjoy them. You do reduce taxes, but you can see the problem with that is you don't have the advantages of letting others enjoy the productivity of your life. So let's focus on those two options of gifting versus sales. Now before I go down that road, I want you to kind of get the basic principles here. And one set of principles relates to taxes. And I'll be as simple as I can be. I won't go into any of the details of how these tax provisions work, but I want you to get the basics. And essentially here you're looking at, think of a triangle of tax issues. One leg of that triangle would relate to income tax. There are income taxes that are triggered or avoided depending on how you do these sorts of transactions, and you want to think about that sphere of effects. And then also in this triangle you have another leg, and that leg would be gifting taxes. So there are gift taxes associated with these transfers potentially. But now remember, you only trigger a gift tax if in fact there's a donation. If you receive something in exchange for it, if there's consideration, if it's a bargain for exchange, then you're not going to be subject to gift taxes. And we'll talk more about that in a little bit. But then there's the area of gift taxes. And then finally the third leg of this triangle, and that relates to estate taxes. Now there's a relationship often between these three, but sometimes there's very little relationship because technically speaking the rules governing income taxes, the rules governing estate taxes, and the rules governing gift taxes are really very independent, meaning that you can have a transfer that is considered a gift and you're charged a gift tax for it, and oddly enough it's also considered being in your estate for purposes of paying an estate tax. Now fortunately there's a mechanism in the calculation of your tax liability that allows you to take a credit for what you paid during your lifetime for those actual taxes on the gifts. But keep in mind though that these statutes conflict with each other, so that what might be a gift may also be in your estate. So it makes this planning kind of complicated because you do have to think about it. So when you think about taxes, and as I move along here in the next few minutes, I'll make reference to one of these three legs. But I also want to move to another area of discussion before we come back to taxes, and that's the area that what are you accomplishing whenever you're doing these lifetime transfers? Well, really what you're trying to focus on is reducing the size of your estate at death. Now, we've talked before about the fact that that can have implications. Some are unfavorable as well as many favorable. The favorable implication of that is, of course, you would reduce your estate tax. An unfavorable influence, an example of this triangular set of considerations I just mentioned, is that you don't get the stepped-up basis that you would get if many of these assets pass through your estate. And I've talked about this in previous shows. I encourage you to go back and look at that. But essentially the core of that idea is that if you have a property, say a piece of real estate that you paid $100,000 for, and you die and its value at your date of death is $500,000. Well, it's one of the examples of IRS largesse, or a benefit that's afforded the decedent, the person who's died, and that's that you get the stepped-up basis. Well, obviously the real benefit is enjoyed by the beneficiaries. So that the new basis for tax purposes on that asset would be $500,000, which means if it were sold 5 days later, and there would otherwise be $400,000 of gain, and if it's sold for, say, $525,000, there's $25,000 worth of gain. So that of taxable gain, and that may be a capital gains rate. It is right now, may not always be. Capital gains rates, incidentally, may go away. There's lots of speculation about that. But the point to remember here is that there can be good reasons for keeping certain assets in your estate. But many people who are doing planning where they don't see that point in the future when they're going to die and this will go through their estate, and as a result they can do those calculations, there's a lot of uncertainty, and there could easily pass 10, 20, 30, 40 years before the event takes place that would otherwise trigger the estate tax until the death of the client, of you in this case. So when you're doing that planning, you're often not willing to settle for that stepped-up basis, particularly when you're talking about an asset like a family business. A family business, may have very little basis. In some cases, a business after a number of years has virtually no basis and a value in the millions. So all of that is potentially taxable.